Hey everybody, Randall Cornett here. I hope you guys are having a great evening so far. Making this video because I wanted to kind of update you, get you guys up to date with what I'm looking at. I don't have a full understanding or all the pieces of the puzzle just yet, but I have enough to where I feel like I could share you guys to kind of give you an idea where my headspace is at. And I got to be honest, this is not 100% directed to AMC, but the market as a whole. But I think this is really scary and serious stuff. So hopefully you guys will find value in it like I did. So what we're looking at right here is a list of trades from January 1st of 2021 to now. There's 10,000 trades here on this specific, chart that we're looking at. And we're looking at IR swaps on inflation. So where do we start here? Well, IR swaps. So an inflation swap is what it means. That's an IR swap. And let's go ahead and I guess start at the top, because this might be a little bit of a longer one, guys. An inflation swap. What is an inflation swap? An inflation swap is a contract used to transfer inflation risk from one party to another through an exchange or fixed cash flows. In an inflation swap, one party pays a fixed rate cash flow on a notional principal amount, while the counterparty pays a floating rate linked to the inflation index, such as the consumer price index or the CPI. Remember that because that's really important to this whole video, the consumer price index. The party paying the floating rate pays the inflation adjusted rate multiplied by the notional principal amount. Usually the principal does not change hands. Each cash flow compromises one leg of the swap. And so here are the key takeaways. An inflation swap is a transaction where one party transfers inflation risk to a counterparty in exchange for a fixed payment. An inflation swap can provide a pretty accurate estimation of what would be considered the break-even inflation rate. Inflation swaps are used by financial professionals to mitigate or hedge the risk of inflation and use the price fluctuations to their advantage. How inflation swaps work. Inflation swaps are used by financial professionals to mitigate, in parentheses, hedge the risk of inflation and to use the price fluctuations to their advantage. Many types of institutions find inflation swaps to be valuable tools. Payers of inflations are typically institutions that receive inflation cash flows as their core line of business. A good example might be a utility company because its income is linked either explicitly or implicitly to inflation. So they might be playing those interest rates on an inflation company or a bond in an inflation company. But anyways, one party to an inflation swap will receive a variable floating payment linked to the inflation rate and pay an amount based on a fixed rate of interest, while the other party will pay the inflation rate linked payment and receive the fixed interest rate payment. Notional amounts are used to calculate the payment streams. Zero coupon swaps are most common, where the cash flows are swapped only at maturity. As with other swaps, an inflation swap initially values at par or face value. As interest and inflation rates change, the value of the swap's outstanding floating payments will change to either be positive or negative. At predetermined times, the market value of the swap is calculated. A counterparty will pay will post collateral to the other party and vice versa, depending on the value of the swap. So what are the benefits of the inflation swaps? The advantage of an inflation swap is that it provides an analyst with a fairly accurate estimation of what the market considers to be break-even inflation rate. Conceptually, it is very similar to the way the market sets the price for any commodity, namely the agreement between a buyer and a seller, between demand and supply, to transact at a specified rate. In this case, the specified rate is the expected rate of inflation. So they're basically betting on taking different sides of on basically what way the inflation is going to go. And so if you're on the right side of that, for instance, you have fixed, you're on the fixed side of that, and inflation drops and it goes crazy sky high, you may not be benefiting as much, or as vice versa. If you have you'd want to be fixed because you're locked in at that rate, right? But if you're on a floating interest rate, you're benefiting, for instance, maybe when it's down or, just throwing this out there, the Fed's printing money or whatever, whatever the case may be. But so you could benefit by if it goes lower, but again, you also face the risk if the interest rate skyrockets, you're on the hook for that as well. So there's both two sides. People are like taking different sides of the trade depending on which way they think inflation is going to go. So here's an example. An example of an inflation swap would be an investor purchasing commercial paper. At the same time, the investor enters into an inflation swap contract, receiving a fixed rate and paying a floating rate linked to inflation. By entering into an inflation swap, the investor effectively turns the inflation component of the commercial paper from floating to fixed. The commercial paper gives the investor real LIBOR plus credit spread and a floating inflation rate, which the investor exchanges for a fixed rate with a counterparty. So that's a lot of stuff there. The main thing that I wanted to take away, so because these are inflation swaps can be a lot of different things, but no, they're based around inflation. And for the case of what we're talking about here in this video, we're looking at the consumer price index. So how did I even get here? When I started looking at these trades, I would start, like, for example, let's look at this one right here. We're looking at, so you can see the time it was executed, if it was cleared or uncleared. You can see the settlement, what it is, the currency, asset class, right? Which again, we're looking at inflation swaps, right? IR swap inflation, and we're looking at the underlying asset. So I looked this up. I Googled it. What is it? It's the consumer price index. Okay. So again, a little bit more reading. But it's important you guys understand this. So that's the purpose of the video. So the consumer price index is a measure that examines the weighted average of prices of a basket of consumer goods and services such as transportation, food, and medical care. It is calculated by taking price changes for each item in the predetermined basket of goods and averaging them. Changes in the CPI are used to assess price changes in the associated with the cost of living. The CPI is one of the most frequently used statistics for identifying periods of inflation or deflation. It may be compared with the producer price index, the PPI, which instead of considering prices paid by consumers, looks at what businesses pay for inputs. So again, the CPI is the most frequently used statistic for identifying periods of inflation or deflation. But this circles back to my theory. And again, my theory is my own, guys. I am not very good at all this stuff. I'm learning just as much every day like you guys are. But if you were so far out in your positions in stocks like AMC, GameStop, and other heavily shorted stocks, and you were so irresponsible that it really could be leading to a potential market crash, the Fed, you already know, has been printing money. Inflation's happening. This seems like a way that these hedge funds could bet on the opposite side of all of this and try and make some money out of this, right? While the world is burning. So I'm just trying to shed light on, and this is just my take. And again, if there's people in here that are financial gurus and want to enlighten me more on the subject, I'd love to discuss this with you. The key takeaways, though, for the CPI, the Consumer Price Index measures the average change in prices over time that consumers pay for a basket of goods and services. CPI is the most widely used measure of inflation and, by proxy, of the effectiveness of the government's economic policy. So CPI is a proxy of how effective the government's economic policy is. The CPI statistics cover professionals, self-employed, and unemployed people whose income are below the federal poverty threshold, and retired people, but excludes non-metro or rural populations, farm families, armed forces, and people who are currently incarcerated and those in mental hospitals. So they don't take data from quite everybody, but it is still a good general look at things from an over-the-top perspective. CPIW is the Consumer Price Index for urban wage earners and clerical workers, while the CPIU is the Consumer Price Index for all urban consumers. Okay? And understanding the CPI inflation is the decline of a given's currency purchasing power over time, or alternatively, a general rise in prices. We all know this. A quantitative estimate of the rate at which the decline in purchasing power occurs can be reflected in the increase of an average price level of a basket of selected goods and services in an economy over some period of time. So now we know that these are inflation swaps based around the consumer price index. So basically trying to play if the inflation goes up, if the inflation goes down. You can see they're putting in the 5 and 10 year here, the 5 and 10 year, bonds of these are 2.5 billion and 31.65 billion. Absolutely. Oh, I'm sorry. 44 billion on the 5 year and 31 billion on the 10 year. And that's from January 1st to August 9th is what we're looking at. So let's go look at some information here. And this is some stuff that's kind of the scary stuff. So the consumer price index is, this is for the CPIU, right? Which if we go back, CPIU is the consumer price index for all urban consumers. So that's pretty much encompasses the majority. So where the hell was I? Okay, so it had increased by 0.9% in June, and on a seasonally adjusted basis after rising 0.6% in May. The U.S. Bureau of Labor Statistics reported today this was the largest one-month change since June of 2008. Over the last 12 months, the items index increased 5.4% because seasonal adjustment. This was the largest 12-month increase since 5.4% increase for the period ending in August 2008. The index for used cars, this is interesting because everything new cars are getting sold right now. The index for used cars and trucks continued to rise sharply. Everybody taking their stimulus checks and probably buying cars and shit, increasing 10.5% in June. This increase accounted for more than 1/3 of the seasonally adjusted all items increase. The food index increased 0.8% in June, and a larger increase than the 0.4% increase reported for May. So here's chart 2, the 12-month percent change in CPI for all urban consumers, and it's not seasonally adjusted for June 20th, June 21. Okay, so the blue is all items, purple is all items that doesn't include food and energy. And this is not good. When they're basically rising simultaneously, skyrocketing. And this is just speculation here, but look at when they started doing it. January, February, look, really February on the dot. I think that's kind of telling of what the hell is going on. This is absolutely mind-blowing to me, right? And so let's look at this graph here. So a percent change in CPI for all urban consumers. Okay, so if we're looking at food, your food's gotten a little bit more expensive. I'm sure if you've been to the market, you notice beef and chicken and everything's went up. So in December of 2020, it was 0.3. Fast forward all the way to June, we're at 0.8. Okay, food at home increased. Food away from home increased. Now the energy is increased. Well, as a whole, energy commodities is actually down. So at the beginning of the year, it was up, and you're seeing it crazy, like rapidly decline. But then you look at something like fuel or gasoline now, and it was up there high, and it's declining as well. And then boom, June, it spiked back up again. Let's look at energy services for utility piped gas service. Okay, 0.4, 0.4, and then bam, it starts spiking up again. So interesting enough, you can see that a lot of these numbers of CPI is increasing pretty heavily. Let's take a look at the CPI Inflation Calculator. So this is the scary part, guys. 2021 CPI and inflation rate calculator for the United States. This table shows the monthly all items consumer price index, the CPIU, as well as the annual and monthly inflation rates for the United States in 2021. So look at the CPI here in January, monthly inflation rate 0.3, yearly inflation rate 1.4. And you just see it go from February, boom, spike, March, spike, April, spike, May continue to run. This is all the data that we have so far. But you see this inflation rate go from 1.4, 1.7, 2.6, 4.2, and 5%. You know, absolutely freaking bonkers. The latest CPI will be added to this table as soon as it's released by the BLS. So we can't see this yet, but when it's updated, this is going to be something that I'm going to start tracking now as well. So we have several different things to look at here. And the most important thing is that I'm trying to convey is I think that these guys are trading these inflation swaps based around the consumer price index to hedge against inflation, which I think is potentially one of their plays to negate, not going bankrupt for their irresponsibility and a market crash. I'm trying to see and identify obviously more connections to AMC directly, but this is much more of a bigger systemic problem. And so for that, and this is, like I said, there's a lot of information here, and it's almost, to me, was looking like gibberish. So I'm trying to share with you guys as I learn. But the amounts that are getting shown in here, like this one right here, this is $64 million. Okay. This is where the big money is trading. Oh, again, the CPI. They're trading on inflation. It's the 5-year and the 10-year. And we'll be getting more into this, and as I find more, for sure. And I actually do believe I've got one more thing here for you guys. So is this what we looked at already here? Yeah, so we've got this inflation rate going up, and then I want to show you guys the actual. Here we go. New vehicles, again, this percent change is crazy. 45% increase on new and used purchase vehicles. I think that they're literally betting against our shit. The CPI inflation rate is going skyrocketing, and all the things that we basically need to survive. And I'll be looking more into the connection, like on the entertainment side of these things, and how that could be potentially being looked at as well. There's just so much, guys, that it's almost, in a way, overwhelming, everything that they're looking at. And you can just see it just spiking. Look at this. The graph is just, it's crazy. This is the 1 month percentage change for CPI. And these guys are betting, and I think going to make money by playing, by doing inflation swaps on these damn things. So that's where I'm at right now. There's a lot of shit going on here. And I hope you guys tune in for the next one, because I'm going to be digging heavily into this. And this is not even the bombshell that I mentioned in my previous video with Astro and Bigham's. That's even bigger. But that did lead me kind of down this rabbit hole. If you guys enjoy the content, you guys know what to do. Do me a huge favor. Subscribe, like, share. I love you guys a long time, and I'll catch you guys on the next one. Peace.